Alrighty, everyone. Happy Fed Day. The day has come yet again. St. Powell has visited us from on high, and he has delivered another 25 basis point rate hike. Now, apparently, some people were expecting a 50 basis point rate hike. I don't understand why. There was a lot of chatter about that the last couple of days. Apparently, a lot of people were betting big money on there being a 50 basis point rate hike. Personally, I can't recall the Fed ever in a rate hiking cycle going from 50 basis points to 25 basis points and then increasing it again. That just, I mean, not that the Fed has normally done the whole 75, 50, 25 stepping it down process. Anyway, this is new, but I mean, to the idea that the Fed would increase the rate of rate hikes mid-hiking cycle, it seems so unlikely, given who these people are and the way they think. I guess it's a product of a very different perspective on how Powell was acting. I think that there are some people who believe deep down that Powell is fundamentally, a hawk, rather than a dove cloaked in hawk's feathers. My bias against Powell is always on the dovish side. I think that Powell, at his heart, wishes that he would never have to raise rates in his entire career. But here we are, and reluctantly he has done so, and he's doing so very slowly. And he's even signaled to us before today and now today again that these rate hikes are going to come to an end. That they will not go on forever, and that we are, approaching where he thinks is probably the correct rate. Now, no human being can actually perceive. We can't, just using our own mind, divine the natural rate of interest, or the neutral rate, as Powell likes to call it. There is such a thing as a neutral rate of interest. The neutral rate of interest is whatever the market rate would be, wherever the supply and demand for savings, in an actually, in a depositor-funded lending system, that would be your neutral rate of interest. In other words, in an actual market-driven system, not one that's centrally planned, you would have society's propensity to save determining what the rate of interest is. The more money people save every month, the more money there is in the banks, and if the banks are flush with cash, they can lend more out. And whatever market rate they arrive at, based on supply and demand, how many people, how much money is being saved versus how much money people are looking to borrow, that would set your interest rate. We are so far removed from that it is impossible to divine anything close to a neutral rate of interest. And by neutral, he means that the Fed is neither being inflationary nor deflationary. The Fed is neither being accommodative nor restrictive. They are just allowing the economy to do as it wishes. The neutral rate, as the Fed sees it, is one where the Fed neither is boosting the economy nor holding it back. Right now, Powell thinks he's being restrictive, which implies that in due time, probably sooner than many people think, the Fed will begin cutting rates. Because if it is restrictive, that might be appropriate as far as the Fed is concerned when inflation is out of control. But once inflation is under control or getting under control, because now we're not even talking about, hey, let's get inflation under control. They're saying, well, let's begin the process of disinflation. That's the new goalpost. Okay, well, what's disinflation? Well, disinflation just means that the rate of inflation is declining, i.e., the cost of living is going up. We all agree on that. But we just want, the second derivative of the cost of living, the rate of change of the rate of change. We want to reduce that. So we're not looking at where the cost of living is and saying, hey, we got to get the cost of living back down to 2019 levels, before we had all this, insane inflation. They're not saying, hey, we need to get, the rate of change of the cost of living down to 2019 levels. We need to get it back down to 2%. What they're saying is, well, no, we want the slope of the graph of the rate of change of the cost of living to be downward sloping. In other words, the goal is not getting inflation back down to 2%, which in and of itself was a ridiculous goal, because the goal was still to increase the cost of living. Even under ideal conditions, the Fed was making us all poorer year in and year out. Even if you took the CPI, or the even more neutered core PCE inflation, as gospel, and believed that that 2% number actually reflected reality, which it didn't. In reality, inflation was much higher, even back when the Fed was, below its target. Powell's not even talking about getting back to that point before pivoting. Now, to be fair, he's not saying that he's going to pivot yet. He's not, announcing, hey, rate cuts begin next month. No, Powell is still saying that the Fed's probably going to hike, 1 or 2 more times. And so that would probably be 5%. He's leaving himself a little wiggle room. Is 5% going to be the upper limit? Or is 5% going to be the lower limit? Because when the Fed hikes, there's always a range. It's a 25 basis point range, and they raise the floor of that range by 25 basis points every time. So right now, the range is 4.5% to 4 3/4. So 4.5 to 4.75. The next rate hike would put the range at the low end from 4.75 to 5.0, and and then a rate hike after that would be 5.0 to 5.25. So either way, whether it's 1 or 2, he could say, well, we're right at 5% now, and that, I believe, was the Fed funds rate target when it peaked back in 05. The hiking, or was it 06? The hiking cycle that preceded the 2008 recession. And so when you think about it that way, we may not be, experiencing the big crash until 2024. The worst always comes after the Fed has concluded its hiking cycle and has actually begun cutting rates, or at the very least, sort of letting things go even. Now, the stock market apparently is all very happy about all this news. They think that the Fed, and today, that this was a dovish hike. They think that for some reason this is better than they expected. I don't know. Personally, I never bought into the 50 basis point hype, so I don't know what they're so excited about. I think that when the market gets like this, people are just looking for any reason to buy stocks. And today their reason was, well, it could have been 50 basis points, and so since it was only 25, hey, there we are. But usually, these rate hikes are already priced in by the time that the Fed makes its announcement, and so people who are trading short term, on the rates, once the Fed announcement has been made official, they're going to, a certain percentage of those people who are not, long-term hodlers are going to close out that trade. And so had someone shorted the stock market in anticipation of a rate hike, well, as soon as the rate hike happens, that trade is over, and so you're going to cover and close that out. I'm not trying to imply that, a 2% move in the NASDAQ is 100% short covering. I'm not saying that at all. But what I'm saying is that it is normal, as long as there is not some hawkish surprise for asset prices to end the day higher after a Fed rate hike than it closed, the previous day. And I guess, since technically, there was a mixed anticipation in the markets, I'm not exactly sure what the Fed funds rate, was priced in. I don't think that they had priced in a full 50 basis point hike, but they had priced in something above 25, which left, a certain room for a possibility there. As soon as it was certain that it was 25, well, then that technically would be, a surprise to the downside, to the dovish side. And so then that, you could say had to be priced in by people buying more stonks. Now, personally, I've never been a fan of the "it's different this time" mentality, and so, as long as stonks remain above reasonable levels according to all the historic metrics like market cap to GDP or P/E ratios, stocks are not of interest to me at any price. Not that I have millions of dollars to throw around anyway. But I'm saying from that perspective, I do think about these things. Hey, if I had money right now, what would I be doing with it? I would not feel very comfortable buying assets with it. I'll say that. Maybe what I would do, and obviously this is not financial advice. I'm not a financial advisor, so don't sue me if you do this and it doesn't work out. But what I would probably do if I had a bunch of cash laying around would be trying to buy, I guess, bonds that are maturing in the next couple of years. You can get some decent bond yields right now. So if you buy something, let's say off the run, that has a couple of years left, and you're able to get, 4.5+% yield, then maybe it'd be worth buying those, collecting some interest for a couple of years and then getting your cash back, and hopefully by then assets in general will be a lot cheaper. Now there's also the risk of default, so it depends on what asset you're purchasing. But just from my general conservative mindset, my certainty that things are very much overpriced and expensive right now, you don't want to buy things when they're expensive. Hey, you park your money somewhere, collect some interest, and wait for things to become cheap. Obviously, that's not the dominant view, or else the stock market would have already crashed a long time ago. Most people don't care, it seems, about P/E ratios or market cap to GDP. And so I have no illusions about what I just stated being a winning strategy. But if you keep playing the casino when prices are already so elevated, one of these days you're going to take a hit, and it could be a substantial one. And when you're getting in this close to a perceived top, obviously right now stocks are well below all-time highs. Good thing you didn't buy back then. Now, if you did buy back then, I don't see you getting that money back for many years. But if you buy now, who knows how much higher above the current levels we're going to see stonks get. We're seeing companies announce a lot of layoffs. It seems like more and more every day. This is not yet reflected in the unemployment rate. Unemployment, we're told is very strong, but we're hearing about a lot of layoffs. And so, there's got to be some way to square that circle. I think everyone who doesn't buy into Wall Street propaganda goes through an era in which they just look at everything and they say, oh my gosh, there's no way that this house of cards can hold together. This has got to fall apart. And as the years go on, and that hasn't materialized to the extent that one would expect, you run the risk of being labeled a perma-bear. But to me, a perma-bear is someone who says, hey, stocks are going to collapse tomorrow or in the next month or, in the next few years. And I've made bad calls like that before, even though I never claimed to be an expert or a professional. I just said, hey, it seems like the way things are going, things could get bad in the next 6 months. And then, here we are all these years later. And so part of that is just learning. I've learned that my, my own pessimism can come back to bite me. And so I'm not going to sit here and make bold claims. We should have had a recession, if in a market-dominated economy multiple times since I've started this channel. You had 2018, you had 2020. Those were pretty big flashpoints, which ended up not turning into a recession because of massive, unprecedented interventions. And so even though, like clockwork, in modern American history, the Fed hikes rates, we have a recession. Recessions follow rate hiking cycles. I'm not going to claim that this time because I don't know what new crazy interventions they might invent. They're going to. We thought in 2020 that the CARES Act was insane and over the top. Well, maybe the next CARES Act will be like $5 trillion. You never know. So who am I to say that things have to crash on paper? I mean, I do think that our economy is far less healthy than it was, when I started this channel. But that doesn't show up on paper as much. It shows up in the form of scarcity, cost of living, just general economic hardship. But the powers that be have used their power to manipulate what we're told are the established and accepted metrics for judging the health of the economy, and they have managed to make those numbers continually go up. GDP goes up, the stock market goes up, and we're supposed to just be happy with that, even though the cost of everything that we buy goes up substantially faster than our own incomes. So, with that said, I will see you folks back here tomorrow.